What's up, everybody? In today's video, we are going to be going over 7 different ways to pay off your mortgage faster, in some cases as little as 5 years. So I have my top lender with me, Rich Conlon, and we're just going to keep this video to about 10 minutes. Some of these strategies you might have heard of, some of these I can almost guarantee you haven't. So let's jump into it, and the first way is to make extra payments.
Yep, that's the common term that everybody knows. You can make one extra payment a year, okay? So 13 payments a year, in essence, and on average, that's gonna save you about 6 to 7 years on your loan. So converting a 30-year fixed loan into a potentially 23 or 24-year amortized loan. The other is also bi-weekly payments, right? So making 2 payments in 1 month. This is something that you'll certainly want to reach out to your servicer, make sure, as some have different rules with regarding, but is another way in which you accomplish that same goal of reaching that 12 or that 13 payments in 1 single year.
And one thing to know, if you have a 30-year loan, and we'll talk about this in one of the other points, but you can make it like a 10-year loan if you want. If you keep making payments, there's nothing stopping you from making additional payments and turning that 30-year mortgage into 15, 17, 25, whatever it is you want. So the second way is to recast your mortgage. And it's kind of similar to refinancing, but a lot of people really don't know what it is.
Yeah, so recasting, it doesn't necessarily shorten the loan term, but what we find most people do, it avoids refinancing, and it's typically when you come into a large lump sum of money, whether that's selling your home or a variety of different large amount of funds coming in and want to apply it to your mortgage. What you can do, instead of refinancing, just apply it as towards the principal, and what they'll do is reset your payment with that lower principal balance. So your payment may be starting at $3,000, but with the recast of say $100,000 to that loan could reduce your payment to $2,700, $2,500 a month. Right? So it doesn't shorten the loan term, but certainly reduces your payment, which then you can apply more.
And the difference is between a recast and a refinance. So a refinance can cost at least a few $1,000s. Recasting, I believe, is just a few hundred. And with the recasting, it's going to be the same interest rate and the same amount of years, like a 30-year term.
Correct. Yeah, recasting does not change your rate. It is not a refinance, so there isn't a bunch of cost. Recasting, most servicers will just require a couple $100 for their processing fee, but again, it doesn't shorten your loan term necessarily, it doesn't change your rate, but it does reduce your payment.
Yeah, and then maybe you have extra cash every month, and then you use that to make additional payments. So the next one, refinancing your mortgage. So if you have a 30-year loan, maybe you refinance it to a 15-year.
Yes, absolutely. So refinancing from a 30-year to anything shorter than, obviously, a 20, 25, or a 15-year loan is going to, in essence, right, straightforward, black and white, it shortens the loan term. Obviously, your payments may increase from the 30-year fixed payment, but it is a way to save on interest and shorten the life of your loan.
And it's kind of like, a forced savings plan, I guess you could call it.
Yep.
Because like we mentioned, with a 30-year loan, you can still pay it off in 15 years. With a 15-year mortgage, you have to pay it off in 15 years.
Yep.
Okay, so the next way is to sell your house and downsize into a smaller house. Like I don't know how you feel about tiny houses. Everyone's the tiny house trend, and you don't have to buy a tiny house, but there's some people with say 7,000, 6,000. Massive houses, and maybe they're not really using all that space, and maybe you can find something in a better location, maybe that's a little smaller, that still fits your needs.
Yes. Yeah, so we typically will see this with individuals or buyers that are in their stages of their life to downsize, right? And have been living in their dream home, but now whether they're empty nesters, what have you, or relocating from a very high transient area like the DMV to going further south, right, where the home values and they're looking for a smaller home, right? Once they do sell their long-term dream home that's at a high value, taking those proceeds and paying off whatever they used or whatever financing they have on the home that they downsized to. A lot we'll see where they're going to go ahead and buy their smaller home, move in, and then plan to sell their current long-term dream home. Once they do, they'll take those proceeds and then pay their their smaller downsize mortgage, if you will, pay it off full and clear so that they're only left with just paying the property taxes and the insurance on the home.
And it's crazy. So Rich and I are in the DC area, and obviously if you're looking to buy or sell or get a loan, we can help you out with that. Reach out to us. But yeah, it's crazy when you look at prices outside of this area, especially south or different areas, what you can buy. Now the DC area is great because the values tend to appreciate and you can build a lot of equity, but yeah, you start looking on Zillow and
Yeah,
man.
yep.
So this next strategy, this is kind of a controversial strategy, and we are not financial advisors, so definitely do your own due diligence. Just kind of giving you some more ideas to think about. And this is kind of called velocity banking. And basically the idea, and there's actually a few books on this on Amazon, like how to pay your mortgage off in 5 years, 7 years. There's a lot of YouTube videos. Basically the idea is you would take out a home equity line of credit, let's say for $50,000, and you would take that entire home equity line of credit and apply it towards the principal of your mortgage payment. Make sure you specify with the bank that it goes towards principal. And right there, you probably just took a chunk of 5, maybe 10 years off the course of your mortgage. Now, obviously, you still have to pay off the HELOC, but the idea is that you would set up your HELOC just as like a checking account. So your income goes in there, you pay different expenses out of there, and eventually, after a few years, you might pay that $50,000 off. Maybe it takes you 5 years, maybe it takes you a few more. And then you would now have the $50K additional equity from the mortgage you paid off. And then once you paid off that HELOC, you would renegotiate it and theoretically get like a $100K HELOC, and then use that entire principal to then pay down your mortgage. And if you repeat that process, theoretically, you could pay off your mortgage in a short period of time. Now, it's obviously controversial because you're using debt to pay off other debt. Some people say, because you're paying simple interest versus amortized interest, that it can be beneficial. But
yeah, from a mortgage professional, most likely those scenarios aren't going to be the solution. But it's always about evaluating all options, right? There is no A, B, and C routes to going about financing. Everybody has different cases and structures and in terms of how their financing is. So HELOCs are certainly options. HELOCs are often used for home improvement projects, paying off large amounts of debt. So it is something that you could, but would definitely want, always encourage speaking with the HELOC advisor, also speaking with the current mortgage loan officer, evaluating and making sure that you're not putting yourself in a hole, but certainly something that could potentially be.
Yeah, and you do have to be very disciplined, and it's definitely riskier. But that being said, I would recommend just getting a HELOC just in general, just to have it as more or less a safety net in case something comes up, or home renovations, or you're using it for something productive that adds value as opposed to vacations and new cars.
Yeah, HELOCs are just a good, the great term, safety net. Taking it out, right? Just think of it as like a credit card, but the security instrument is your home. So most are 10 to 15 years of just pure interest only, and that's based off of the running balance. So if you take that HELOC out but don't tap into it, there is no repayment on that time. So again, it's definitely a different payment structure than your 30-year fixed mortgage, and something that you can draw off of when in need for emergencies or what have you.
All right, so the next way to pay off your mortgage faster is really just getting a lump sum payment. So some people, some people just get a windfall of cash. I know that I would love to have that happen. That sounds great. Or a tax refund, could be any inheritance, could be any number of things. And you could put that towards your principal and knock off a few years.
Yep, yeah, so it kind of can sort of fall in the same sort of lines with the recast, but there are, a principal curtailment, right? Taking large lump sums and applying it strictly to your principal. It also may not be enough to just reset your payment, right? But it is another way to shorten the loan term by reducing that loan balance. So certainly kind of a little bit along the lines of a recast, but maybe not necessarily in terms of the amount that big of a difference.
And then a few other things that go in line with that is, you could obviously rent out space in your property. If you rent out a room for, let's say, $1,200 a month, that's a pretty, after the course of a year, that probably took a good chunk out of your mortgage. Or even getting a part-time job to pay off, your mortgage. If you can find a cool part-time job, that's another option as well. The next one is to round up your mortgage payments. And this one's not going to have as significant of a difference as some of these other ones, But if you do a few of these strategies, you could probably shave off quite a few years off your mortgage.
Yeah, I mean, it just kind of goes to the saying, every bit counts, right? So it could be, in terms of your rounding up, could surmount to what we talked about, one extra monthly payment a year, right? This could accomplish that without you really even knowing. Rounding up, I think from a logical standpoint, or just a mental standpoint, when you just see that round number instead of crooked numbers, it may just simplify things for you, feel a little bit better, right? And obviously, applying it slightly more is going to help just pay a little bit more in terms of that principal, and thus shaving a little bit of time.
And when I say rounding up, it's like, let's say your monthly mortgage payment is like $1,875 per month. Maybe just pay $2,000 per month and round it off like that, and then make sure with the bank that it's going towards principal and not interest. All right, so if you have any questions, or you're looking to buy or sell in the DC area, or really any area, we have pretty much different connections like nationwide that we'd love to assist you if you're looking to buy, sell, or definitely invest. Definitely reach out to us. Our contact information is below, and we'll see you in the next video.
Take care.